Welcome back to Crypto Pulse, the show where we cut through the noise and give you the signal. I'm Alice Chen.
And I'm Mark Russo. Alice, it's the last day of November 2025. Bitcoin's chilling above 90K after the post-election run, and yet, Ethereum is still licking its wounds under $2,800. Feels wrong, doesn't it?
It really does. And then yesterday, this clip drops. Tom Lee, managing partner at Fundstrat, chairman of BitMine, the company that now owns 3% of all circulating ETH, goes on Wealthon and casually says, "We think ETH can be $7,000 to $9,000 by the end of January. That's literally 3 to 4x from here in 8 weeks.
8 weeks. That's not a bull case, that's a moonshot on Red Bull. So today we're doing a full autopsy of that interview. Why Tom thinks a tokenization supercycle is about to kick off, why he's comparing it to Nixon leaving the gold standard in 1971, and whether this is genius or 2021-style hopium.
Let's start with the headline prediction and work backwards. Here's the exact quote from minute 0. Tom Lee, "We think ETH can be $7,000 to $9,000 by the end of January. That's a huge recovery move, but that's also pretty typical of what could happen in the fourth quarter."
Typical? Alice, remind the audience what Ethereum actually did in the fourth quarters of bull years.
Happy to. Q4 2017 plus 360%. Q4 2020 plus 180%. Q4 2021 plus 110%. So yeah, if you squint, a 250% move in 2 months isn't impossible in an ETH Q4 moon cycle, but we'd need the perfect storm.
Exactly. So what's Tom's perfect storm? He makes this wild historical analogy, says 2025 is to finance what 1971 was when Nixon took us off the gold standard. Walk us through that.
Okay, Tom's core thesis in one sentence. The dollar went synthetic in 1971. Wall Street invented money market funds, CDs, futures, ETFs to protect its reserve status. The dollar went tokenized in 2017 to 2024 with stablecoins. Now Wall Street is about to invent everything else on blockchain to protect its dominance again.
And his punchline is that Ethereum is the rails for that everything else. Stablecoins with a ChatGPT movement for tokenization, the first killer app, and now the floodgates open.
He points out Tether's raising capital at a reported $500 billion valuation. That would make it the second most valuable bank in the world after JP Morgan, with 300 employees instead of 313,000. That efficiency gap is insane, and it's not stopping at stablecoins.
He also says, and I love this, as a fiduciary, if liquidity were equal, you would always buy the tokenized version of any asset because you can hedge it 24/7, including weekends. So slowly, then all at once, everything tokenizes.
And Ethereum wins that race, in Tom's view, for 3 reasons. Sheer size, it's 5 to 10x bigger than the next L1 in TVL and developer mindshare. 100% uptime, neutral, truly decentralized. And the community actually ships. Polymarket didn't come from Goldman Sachs. It came from ETH builders.
Speaking of Polymarket, Tom thinks we're one pro-crypto CFTC chair, maybe Mike Selig, away from prediction markets going fully mainstream, and that's just the appetizer.
Now, the million-dollar question, why is ETH still under $2,800 if all this is so obvious?
Tom's answer is brutal but honest. Public tokens price psychology, not just fundamentals. Ethereum is still an immature asset with almost all of its growth ahead of it, so it's hyper-volatile. He brought on Tom DeMark, the godfather of technical timing, as an advisor to BitMine, and DeMark apparently sees engineered systematic liquidation happening right now, probably from the October 10th Cascade crash.
For anyone who missed it, October 10th was the crypto Black Thursday. Bad pricing feeds, low weekend liquidity, over-leveraged market makers, cascading liquidations. Tom thinks some large player is still bleeding out positions reflexively as price falls. DeMark's downside target? $2,500. And Tom actually said it would be ideal if we wicked down there because that flushes the last seller.
So we could still have another 10 to 12% downside, but then the slingshot.
Exactly. Once the forced selling stops, institutions step in. Tom sees a flippening, not of market cap over Bitcoin, but of ownership. Retail is washing out. Institutions, including BitMine itself, are accumulating.
And BitMine's fascinating here. They own 3% of all ETH, about 3.6 million coins, heading toward 5%. They just launched the Made in America Validator Network, OFAC compliant, Wall Street friendly staking, They announced a penny per share dividend, tiny, but no other 9 billion plus crypto stock pays one. They're even investing in WorldCoin's Artwords treasury because proof of human matters in an AI agent future.
In other words, BitMine is trying to be the micro-strategy of Ethereum, but with a very different playbook. Less debt-fueled leverage, more bridge building between Wall Street and the Ethereum Foundation.
Let's talk price action realism, though. $9,000 by end of January would require ETH to do in 8 weeks what it took 4 months to do in late 2020. Possible? Yes. Probable?
Here are the tailwinds Tom is counting on. Trump administration equals regulatory de-risking on steroids, Genius Act, friendlier SEC, etc. Basel III rules being rewritten to treat public blockchain assets more favorably. Fed likely cutting rates in December or January once political optics clear. Spot ETH FTF still have massive inflows queued up, institutional pipelines are slow. L2 summer and restaking narrative reboots in Q1 2026.
In the headwinds? Still unresolved leverage from October 10th, macro scare if the Fed stays hawkish too long, general crypto fatigue after the 2025 mini bear.
My personal probability tree, 30% chance we see 9K by end of January, full meltdown scenario. 50% chance we're between $6,000 and $7,500, strong but not insane Q4. 20% chance we chop around 4K, 5K, and the super cycle narrative slips to Q2.
I'm a bit more conservative. I have the 9K scenario at 20%, but I agree the risk reward from 2,700 is absurdly asymmetric. Even if he's only half right, 5,500 to 6,000 still feels very achievable.
One thing Tom said at the end really stuck with me. Crypto has declines and it feels terrible now, but volatility works in both directions. You have the meltdown, then you have the melt up.
Classic Tom Lee, been saying that since 2018, and it's been more right than wrong on the big swings.
So, final verdict?
Look, $9,000 in 8 weeks would be one of the greatest Q4s in Ethereum's history. It's not the base case, but it's absolutely within the realm of historical precedent if every catalyst lines up. At current prices, long ETH feels like one of the best risk-reward bets in markets right now.
Couldn't agree more. If you told me in 2021 that Tom Lee would be pounding the table for 9K ETH while it's trading 2,700, I would have assumed we were already at 30K. The fact we're having this conversation at these levels feels mispriced.
That's the show, folks. If you enjoyed this deep dive, smash that subscribe button, drop your own ETH Kai's prediction in the comments. Are we going to 9K or is Tom smoking the good stuff?
And as always, none of this is financial advice. Do your own research, manage your risk, and we'll see you in the next one.
Crypto Pulse out.